Hello and welcome to Investing Confidential. Rallies continue in the US. It's not going to last. Chinese stocks are crashing. Europe's about to crash, and we've got an incredible, volatile week ahead with earnings. And let's get set here and let's get ready to go. I want to talk first about China. The talking heads here just amaze me. So we've got massive volatility going on in Asia right now. We've had the worst, one of the worst days in the history of the Hong Kong Stock Exchange. The Hong Kong Stock Exchange has basically crashed, right? You've had a crash in Hong Kong driven by the tech stocks. What I don't understand is if anyone has been, I think investors, a lot of investors should be watching my video instead of, thousands of subscribers. I wish I had millions, because if everyone's watching my videos, I would have told you that the CCP told you what was going to happen last week. No one pays attention. No one reads newspaper. Newspapers. No one reads any newspapers, but no one reads the articles. People just look at the headlines. And why was this a surprise? Why is it a surprise that Xi Jinping is given total control? He negotiated this. What people aren't talking about is part of his negotiation is he's not going to put guys in prison forever anymore, which is what he was doing. So they gave him total control. He put his buddies in there. Why is this a surprise? I have absolutely no idea. And it doesn't make any sense that you would sell the market off. But why are investors selling the market? Well, it doesn't make any sense. But again, people that aren't paying attention to what's going on, who are just focused on whatever Wall Street tells them, whatever investment banks tell them, or whatever CNBC is saying, that this is why this happens. And the sell-off is actually pretty vicious. If you look at these charts here on the Hong Kong Stock Exchange with Hong Kong China-related companies, this is a vicious sell-off, and it's been going on for quite some time. So, why would yesterday or last night, in Hong Kong terms, be when you just flush everything out? It sort of makes no sense, and I think for a trader there could be an opportunity, but I'm going to go into that in a second. But let's discuss what really the real issues are here. Zero COVID policy, which is something that the preliminary meeting last week said they're going to keep. Again, every newspaper is the zero COVID policy. This was a surprise. No, it wasn't a surprise. This is terrible. The zero COVID policy is a huge issue, and it has been a huge issue for some time, and nothing's changed. They last week they said they're going to continue with it. So why today would you sell Chinese stocks because of zero COVID policy? It makes no sense, because this has been the policy for some time, and it's not going to change. And this dovetails into some of the other important things that came out today or over the weekend, which is the Chinese numbers. But no one's reading, no one's paying attention. This zero COVID policy, I'm going to explain again why it's so bad. So the Chinese government has the ability to test, and I said this in a previous, almost 1 billion people a day, right? It's shocking, but this is when you have an authoritarian government. They can do whatever they want. So people, if you're in a zone where there's one COVID case, what they do is they look at a map and they say everyone within, let's say, let's say a half a mile radius is now in kind of a quarantine lockdown. And every day you have to get tested, and every day you have to put that test on your mobile phone app. Let me repeat that. Every day you need to get tested, and every day you need to put it on a mobile phone app. If you do not, you will get a visit by the military or the military police. This is what is going on in China. This is why it's unbelievable, but this is how their policy is. What does that mean? That basically means that consumer confidence is going to continue to be very negative. The real estate markets continue to be a drag, and the Chinese economy is just doomed. It's absolutely doomed. So what did they do? We talked about last week, they delayed the numbers. They obviously massaged them, and they came out yesterday or last night with a GDP of 3.9%, beating Wall Street and World Bank and everyone else's estimates. It's lower than China's own estimates, which they had 5.5%, which is a joke, but they beat all the Wall Street estimates on the day of this big meeting, on the big announcement. And then, Does anyone believe this? Obviously not. The Chinese government transparency of the numbers continues to be very bad. It's not going to change. And so even though they lowered their estimates, they still were able to massage a beat versus the rest of the world. I mean, it's a joke. Okay, I'm sorry, but it's a joke. But again, it's just you have to read between the lines here, right? So you can't believe the number, but you have to see what's going on. So at the end of the day, when you look at real GDP of 3.9 adjusted for inflation, this is, again, put in perspective. The previous quarter, which was the second quarter, was flat to negative. So how did the Chinese economy grow 4% while the rest of the world really just started to crash, especially the US? It doesn't make any sense. Again, don't believe the numbers, but the numbers do tell you something. They did report on back of that strong industrial production of plus 6.3%, but the consumer numbers are weak. None of this makes any sense. The fixed asset investment, which is a big number for China, I mean, how much money you're investing in infrastructure, et cetera. For real estate, this was down a negative 12%. A negative 12%. Remember, as I mentioned in the past, real estate is the growth for China. There is no other industry that generates more growth than real estate. So fixed asset investment, money you're putting in, if infrastructure said it was down 12%. What does that tell you about these GDP numbers? They were fictitious. The consumer confidence is down. All this just tells you it's really not to believe, but again, it is what it is. So what does this mean about specifically for an investor? Chinese tech stocks got walloped in China. They're about to get walloped here on the opening in the US. I don't know where they're going to close, but they're going to get hit because they got hit. Is there an opportunity? For a trader, there is a huge opportunity here if you're a trader, because this is an obvious overreaction. Again, why do I say it's an overreaction? Because the information was out already. I don't understand why people weren't paying attention. The information was out already. Alibaba at some point will trade below its IPO price. Now, that is really negative long term, but for a short term, I mean, I wouldn't invest in Alibaba, but if you're a trader, this overreaction is definitely tradable, okay? One quick thing, in my past, how do you trade things? Things are going to open down. That's usually the flush. So normally you either buy pre-market right before 9:30, or you wait for the flush to continue till around 11 a.m. I would wait for this flush to continue. You're going to get a lot of people puking out, or you buy towards the close like professionals do, market on close. But there's a trading opportunity. If you don't want to buy individual stocks, the FXI a number of years ago changed their overall index, and they this FXI, which is supposed to be a China index, is now almost way overweight U.S. listed Chinese ADRs like Alibaba, who don't trade locally. So FXI is going to get hit. Again, I think there's a tradable bounce. But the real question is for an investor is, are Chinese stocks cheap? Well, one thing that we don't do in the U.S. that they do in Asia is they look at, from a valuation paper, they look at book value. We don't look at book value anymore because of the way the banks have taken over the market, and they want you to look at PE, they want you to look at EBITDA, they want to manipulate numbers. But traditionally, we used to look at book value. That's how, for example, all the great value investors used to look at, 30, 40 years ago, price to book. In Asia, they still use price to book as one of the many metrics they use to value. So look at here, Chinese stocks are getting cheap. They're all below book value. It's looking very interesting. Would I invest today? Absolutely not. But in terms of where does Chinese stocks stand in terms of valuation versus the rest of the world, like all the other emerging markets, they're looking very cheap. So when you see this pivot next year, it's not going to be a time to buy U.S. stocks. You get a little bounce, but the emerging markets, including China, are going to be a steal of the century. They're going to be very cheap, and it's going to be some opportunities. The Chinese currency, which again is a double whammy, Chinese currency is tanking as well. This is not normally what the Chinese government wants, right? They want stability. They want to see the Chinese currency kind of strong, but because their economy is so weak, they're allowing this thing Again, the Chinese renminbi is not a free-floating currency. They're allowing it to weaken because they think they're going to export out of their problem, and that's the way they think. Okay, so this is why the renminbi, the Chinese currency, is very weak. But if you want to see the indicator how bad things are in China right today, okay, look at the Chinese high yield. Again, fixed income markets, the bond markets usually tell us much more about what's going on than the stock markets. So the Chinese high yield is approaching 30%. Okay, our high yield's like 7-8%. This is 30%, and these are bonds priced in dollars. This is telling you the real story. So there's a real problem right now in China, and it's going to be solved at some point. But again, the current situation is a disaster. So how on earth does an economy grow almost 4% when they're a high yield market, meaning the perception that things are just ready to go bankrupt? I mean, it doesn't make any sense. Now I'm going to turn to Europe, and folks, Europe is sinking fast. PMIs came out. If you're not sure of PMIs, Purchasing Managers Index, the actual number doesn't mean much, but you always want to see it over 50, right? So any economy where their PMI is over 50 is good. Anything under 50 is bad. Well, Europe is 47. It's very bad. The PMI continues to come down. This is a leading indicator for an economy. So this week we have the GDP for France and Germany due out on Friday. It's not going to be good. It can't be good. The EU consumer confidence, as you're seeing here, is so weak that I just don't understand how these numbers can be good. Maybe versus Wall Street expectations. Again, don't pay attention to expectations. Look at the real number. Look at the trend. The two strongest economies in all of Europe coming out on Friday with GDP, not good. So you're going to see continued weakness in European stocks, European bonds across the board. The other point is inflation continues to go up in Europe. It's not abating, right? So this will confirm, these numbers should confirm stagflation. So Europe is in stagflation. Again, repeat, Europe as a whole is the largest economy in the world. It is the largest economy in the world combined. Europe is in stagflation, consumer confidence down. China's got major issues. How on earth are U.S. companies going to report good numbers? And now we bring to the U.S. We've got a slew of tech earnings coming out. But before I talk about that, let me show you why the U.S. is in big trouble. This is a chart or statistics of U.S. container import. This means stuff being imported from overseas for consumption. Okay, consumption, which is the number one driver of the U.S. economy. These numbers are tanking, folks. Look at this number. It's tanking. So what is that? That means that the U.S. consumer has just basically stopped. They're not importing things from overseas. We import most of our goods and services, not services, but goods from overseas to consume, from Asia, etc. These numbers tell you the U.S. is the U.S. consumer is very weak. So if we're a consumer-driven economy and the consumption is not good, again, this is a leading indicator, not a current indicator, a leading indicator. It tells you that the future is bleak. The short-term future is bleak. Now let's talk about tech earnings. Apple, Google, Microsoft, Amazon, Meta. Now, Meta, Amazon to a certain extent have less of this currency stuff going on, but certainly Apple, Google, Microsoft, which do a lot of business overseas, they're going to be hit by the U.S. dollar. The U.S. dollar has crushed currencies across the board. The UK, European currencies, Japan, all of these companies not only derive a lot of revenue from overseas, they also do business in all these countries. And these countries are reeling right now. So be careful. Remember, it's not the actual number, it's the guidance you have to focus on. So if Apple comes out or one of these companies come out and they say it beats and it's up in the pre-market, if you're a shareholder, look at the press releases. Focus on what they're telling you about the future, not about the past. Don't look at again these beats by these Wall Street. It doesn't make any sense. So U.S. tech earnings, big volatility this week. Hard to believe that the stock market will continue to go higher, given we are still going to be raising rates in early November. That's a week and a half away. So again, if you're a trader, take advantage of this trend and trade it. But as an investor, there are better days to come. And as always, investors, be careful out there.